An advanced trading strategy is one where you automatically track certain parameters on a stock and generate buy and sell signals. You need to act only when pre-specified thresholds are crossed. And when done right, this can be a profitable approach for traders. But what if you're not a trader or don't have ready access to the tools required or simply do not have the time? Enter quant funds. Quant funds, as their name suggests, follow a set of predefined rules and make adjustments to their portfolios based on the input received from their models. So then, shouldn't everyone just invest in quant funds? Why do we need fund managers? Is it profitable and less risky to invest in quant funds? My name is Neelabh, and welcome to this edition of Kuvera Insights. Today, we will try and understand from an expert what quant funds are, who should invest in them, and what should one expect. Joining us today is Parijat Garg, fund manager at IIFL Mutual Fund. Before IIFL, he has worked with Quant Securities LLP and Tower Research Capital in related fields. Fittingly to our discussion today, he is a computer science engineer from IIT Bombay and a CFA charter holder. Hi Parijat, and welcome to this discussion.
Thanks, Neelabh. Thanks for having me.
So let us quickly get into our discussion. What is the difference between quant funds, passive funds, active funds? There are so many nomenclatures that sometimes it is difficult for an investor to interpret.
Sure. So we have to distinguish between quant and active on the one hand and quant and passive on the other hand. So the principal difference between a quant fund, a well-designed quant fund, and an active fund is that in a quant fund, the day-to-day decision making on what stocks you're going to buy, how your portfolio will be constructed is a fully automated process or a formula-driven process where there is no discretion exercised by a fund manager on a day-to-day level. So once they've built a strategy and tested and put a fund together, then the decisions are automated and they don't really depend on the fund manager. Whereas in an active fund, a fund manager and his team will constantly research companies and come up with the day-to-day buy and sell decisions and portfolio construction. That's on the one hand. Now, what I just described for quant funds, that a formula is decided and then portfolios are built accordingly, that the same can be said for passive funds as well, right? So let's say if there is a Nifty-based passive fund, that's also technically the same thing. There is a fixed rule for constructing the portfolio and no fund manager is taking an active decision. So the difference between a quant fund and a passive fund would be that a passive fund typically is based on some sort of index, so a Nifty index or a BSE 200 index, etc. And they are very specific sort of constructions where there's based on market caps and certain industries, etc. A quant strategy, on the other hand, will the formulas are more complex. Typically, they are more dynamic. They can change more frequently, and they use more parameters than just, let's say, industry or market cap. So they can use price volume data. They can use even the financial metrics they can use to build these portfolios. So between active and quant, there is no day-to-day decision making by a fund manager. Between passive and quant, the difference is that quant funds can be more dynamic and can use far more parameters to choose the portfolios and the stocks.
Right. So that's very helpful. I also want to understand, so there is no category per se as per the SEBI categorization, which says that, using which you can identify a quant fund, right? So apart from the name of the scheme, if it doesn't carry the word quant, then how would you identify a quant fund?
So first of all, to the first part, the answer is yes and no. There is technically a category. It's within thematic category. There is a category of quant funds. But there are other funds as well that are, classified within a different category, and they don't necessarily have a quant name in it, but they are also like fully systematic with no manual intervention, right? So first of all, obviously, just looking at the name, it will be hard to know if there is a certain fund which is actually behaving like a quant fund. So to figure out whether something essentially is a quant strategy, you'll have to read the offer document or the brochure for the the marketing material. And there, the most important thing that you need to pay attention to is whether they are describing a philosophy, right? That we like to buy growth stocks, or whether they are defining a process, right? Where a process will be very formula driven sort of thing. So if the document really gives you a very specific point by point steps of how a portfolio is constructed and stocks are picked, then you can be more confident that this is a quant like strategy. And the reason I say quant like is because in fact there is a big spectrum of quant funds, where there are some that are actually very, very automated, where there is absolutely zero discretion for the fund manager. And then there are some where there is a certain amount of input from the fund manager, which will typically show through in the documentation. So it's a sliding scale. And it's really in the description that you need to read and figure out whether the dominant part of the strategy is formula driven or human driven. And that's really how you can decide whether it qualifies.
Right. So your response led me to my next question. So do fund managers of quant funds have discretion in which stocks are getting invested in, beyond setting the sort of the starting point of the portfolio? And is this, you mentioned a sliding scale, so is there a some kind of a percentage cases where some kind of a disclosure in the documentation? Because you understand that this is a very subjective interpretation that one has to do as an investor or even as an advisor.
Sure. So actually, this has evolved. There have been quant funds around for more than a decade now, even in India, and I think the way they are done has evolved. So earlier there were less. There was a far greater amount of input or discretion to the fund manager, and as the category has evolved, the fund manager discretion has gone down. Having said that, discretion is actually at two different levels. One is, once you've built the formula and you're running the strategy, and then the stocks it picks, whether the fund manager can override the decision that has come out of the system. Right? That is one level of discretion. And then the other is that over the years, right? So you've built a strategy, but over the years, you might realize that there were some flaws in the strategy, that the strategy does not perform well in certain periods, and then you sort of do your research and improve the process, right? So you improve the formulas over time, but you still depend on the final selection. You don't override, right? So there are two different levels of discretion. A quant fund typically will hold a good quant fund. Most funds today, as I understand, will usually keep the discretion to the point where they can update the formulas with time. They can update the frequency with which parameters are reassessed, but almost none will actually run the model, get an output, and then tweak the choices. So that's typically not happening now. The older funds, and there it will show up very clearly. Importantly, it will be very clear if you read carefully whether if there's a lot of discretion, it will mostly read like the fund manager will use quant inputs to build the portfolio. Whereas where the discretion is not there, it will be that this is the process we follow and this is the type of portfolio we invest in. And you can more or less be sure that in almost every fund, there will always be the discretion that you can fix the strategy in case there are flaws. Otherwise it really doesn't make sense.
Understood. So it's more like a oversight kind of mechanism where fund managers get involved when there is any adjustments or tweaks, if they find that the model is not responding appropriately to certain changes, or as we have seen in the last in my career itself, I've seen probably 15 20 of 20 years, I've seen events which can be described as the first ever from a financial market standpoint, right? So that's great to know. And we talk about even within the ambit of quant funds, there are different strategies, investing approaches, if you will, that a fund manager follows and can follow. These are more or less, from my understanding, these seem like established approaches that fund managers would follow. Could you describe some of these and help us understand, why would one strategy work better than another, and is there a need to change strategies, and when would there be such a need?
Sure. So, like you mentioned, there are, so what you are describing essentially are known within the quant world, they are known as factors, right? So the well-known factors, for example, you will hear of a momentum fund, you might hear of a value fund or a growth fund, right? These are, so in the typical traditional investment mindset, these words have certain meanings, but within quant also, they have more quantified meanings, right? What exactly do you mean by momentum? What exactly do you mean by value? These are, mathematically defined terms in quant, and then people can tweak those things. So one class of funds is where a fund will be only a momentum fund or only a value fund or only a growth fund, etc. And then there are multi-factor funds, right? So there are funds that say we look at all of these factors and we combine them. So we'll take some of momentum and we'll take some of value and we'll combine them to create a portfolio. So that's one way to build a strategy. Again, when you read the documentation, it may not show up in the name, but when you read the prospectus, it will become clear that, look, they are using multi-factor approach, or they are using a single factor approach, right? So a multi-factor approach typically is a fund that you can buy, and hopefully it is built in a way that it adapts. So these factors work at different points of time. Let me start there. There are times when momentum works really well. There are times in the market when value works very well. There are times, so for example, value has had a bad run almost for the entire of last decade, but in the last 6-8 months, value has done well, right? So different big factors work at different points of time, but one important characteristic is that over a full investment cycle, let's say a 5 to 7 year cycle, if you stay invested in any given factor, the expectation is that they will generate a positive return, right? That's the only reason something can become a fund. So it's not completely arbitrary. These are factors that have been studied over many decades. That if you buy value stocks over a full investment, it's very important to note. You cannot expect that over a 6-month or a 1-year cycle it will work. But over a full investment cycle, these factors all generate positive returns. But there can be times, then there can be a year when certain factors will not work, etc. So you can either invest in a multi-factor fund, which typically will adjust, and sort of try to do well across regimes, or you can buy specific factor funds. So you might buy a momentum fund, for example. Now, why you would buy a specific, like a momentum fund or a value fund would be, let's say you do direct equity investing. Or let's say you are, even if you are, do active mutual fund investing, then, typical different fund managers have different styles. So there are some well-known fund managers who do value type of investing. So let's say you've bought, you like their funds, you like their way of investing, you've bought some of that. Then within your portfolio, you might want to say, look, value works, but momentum also works, but I don't know any active fund that does momentum investing. So let me add a quant fund that is a momentum fund. So that overall my portfolio is diversified across these factors, right? So that's why you might go and buy a momentum fund, or the other way, maybe you do your own equity investing in momentum, but you might go and buy a value quant fund to say, so that my overall exposure is balanced, right? So a lot of it is about portfolio construction for your own wealth and how you allocate across these things. So that's sort of the idea,
right? No, that makes a lot of sense. Use quant funds and evaluate quant funds from the perspective of your overall portfolio and how does it fit into your overall investing approach, and whether you use it to add or subtract risk will determine what type of quant fund or what investing approach you're following. I mean, everything finally goes back to the basics of asset allocation, and what kind of appetite does one have. So tell me something. If I have to compare an active value fund and a quant fund which follows a value strategy, will which one will have lower risk, which one would have lower cost, and which one should I choose, or should it be a mix of both? I'm just, I know it's a difficult question, but maybe some insight would help on what kind of thought process one should have.
Sure. So value specifically is a slightly tricky one, but I can tell you one thing. So fees is easy to answer. Quant funds are typically cheaper in just the total expense ratio. The quant funds are typically materially cheaper than most active funds. So that's okay. And you'll probably be maybe 50 bips to 100, almost 1%. To the extent of 1%, it might be cheaper. In terms of risk, if you're looking at the mutual fund format, right, it's all of these funds are almost fully invested all of the time. And despite all the changes that you might have, there is the underlying equity risk that is actually the biggest component of risk in any mutual fund investment. So to that extent, whether it's an active fund or a quant fund, you still are exposed to equity risk. So a large part of that will still be there. So the riskiness is not very different. The beauty actually that quant funds bring to the table typically is that they have low correlation, typically have much lower correlation to the other active funds, right? So there might be times when a certain, when the active funds are doing well, quant funds may be doing slightly less well. And there'll be time when the active funds are not doing well and the quant funds will be doing well. So what that does is, even though both of these funds might generate positive returns over time, because they are, when one is doing badly, the other is doing well, etc., portfolio remains much more stable. So the volatility goes down much more. So on a risk-adjusted basis, right, it'll never, it reduces the possibility that suddenly your entire portfolio is experiencing a lot of pain. Right. So that to that extent, these things are, these things are useful. Now, active value versus passive value. See, again, like I said, the terms momentum, value, growth within active typically means slightly different than what quants think about, right? So for a quant, value might just be a price to book or a price to earnings, etc.
Yeah.
But no active fund manager will say that I just buy the cheapest price to book. Right? They do a lot of work to figure out its value relative to intrinsic, price relative to intrinsic value.
Right.
That's what a real value fund would be. Versus a quant fund who doesn't really know how to do that kind of analysis. So to that extent, when you look at, even if you take any well-known value quant fund and an active value fund, you look at their portfolios, they'll be significantly different.
Right.
So they have some underlying commonality, as in broadly they're trying to buy cheap stocks, but they're also materially different. So there's actually no reason why you can't have both in your portfolio. And for the reason that I explained, that they are not very correlated to each other, right? So they are sort of low correlated, reduce your overall portfolio risk within the value stack.
So have both in some allocation, depending on what your investing hypothesis is. But that's that's a very interesting point that you made, that value funds, whether an active value fund or a quant fund which follows a value investing strategy, and I guess the same thing would apply even to momentum if there were momentum funds, active momentum funds, but are not necessary. These two are not necessarily more or less risky as compared to each other, and probably that may not be the right parameter to compare them to each other. Cost is, cost, like you rightly pointed out, is definitely lower because the amount of research involved it's like a fixed cost that sort of goes in the beginning, and then it's a matter of incrementally improving. So these are very useful inputs. One of the concerns that and you've sort of answered this in the way you have described quant funds, but one of the concerns is that, is anybody looking at the companies where my investment is going on a day-to-day basis? If it's a model-based investing approach, then is my portfolio really getting tracked? What if something happens to a particular company and my fund has that exposure? Then how will a quant fund react to something like that?
So two things here. One is, I think in extraordinary circumstances, there is always the leeway for a fund manager to step in and say, this is like looking really, really ugly, right? let's say something like a Satyam happens. Then a fund manager might actually step in and say, we need to take this out of the portfolio. But a well-defined or well-built quant strategy typically will, in fact, the fund manager will resist the temptation to touch anything that, slightly there is bad news in the market, something has happened in the cement industry. The value of the quant fund is precisely that a fund manager will not go and tinker with your portfolio. Because when a quant fund is put together, you basically define a mathematical strategy and you do what is known as a back test. Right? You test whether that strategy, if I had applied that over the last 10 or 15 years, whether it would have made money. Now, when you do that back test, then the fund manager in the back test is not applying his mind when things had gone wrong, if I had taken out this company and that company. If you start doing that, then the back test doesn't make sense because you already know that certain companies were going to fail. And so now if I start tampering with the portfolio, then those back tests become invalid because then you don't know whether, because sometimes there's bad news, the stock goes down. And in fact, those are the ones then will, every fund manager, active fund managers will think that's a bad company. But in fact, that ends up generating the biggest returns. And maybe that's what drove the performance in the back test. So if a fund manager is actively tinkering with your portfolio, honestly, I would say that I would rather buy an active fund if I wanted that. The idea of a quant fund is, look, here is a formula. This formula has been seen to work in the last 15 years. I do not want to apply my mind except to the level where I say the world has changed to a point where this strategy is not likely to.
Right.
But on a day-to-day basis, looking at specific companies, you want that, you should buy an active fund, right? So, and second level, just to sort of, a good, well-built quant strategy is typically diversified enough and the portfolio construction is built in a way that if there are one or two blow-ups in a security that's expected, it's okay. And over a full cycle, again, that will not materially hurt your returns. So you sort of, it's okay. Like, it's expected that some things will blow up. It's fine. The strategy is built to withstand that over a full cycle.
Right. That's very, it's very interesting that you took, you mentioned that particular stock. And the reality is that we have enough evidence of this kind of, sort of not, unexpected events happening very frequently, especially in the last 7-8 years, I would say, maybe over the last decade. So I'm sure some of that data already gets built in automatically, factored into the backtest itself. Now, in terms of the different, and there are many quant funds now available, and though there may be, it may be harder to find some of those quant funds or identify that they are quant funds. But once, let's say, I have identified there are probably 8 or 10 such funds which are available today. How do we make a choice? How does one assess? If I have, let's say, I want to allocate 10% of my portfolio as per my investing strategy, I have 10% space left for investing into a quant fund. How do I choose between these 10 funds? What parameters would I look at, knowing that all of these are quant funds and therefore?
That's a good question. So, look, again, there are two levels at which you can do this thing. One is where you dive into the actual specifications of the fund. And second would be so most quant funds honestly are a little young right now. Very few have more than, let's say, 3 years of history. The most were launched in the last 2 or 3 years. So there isn't a lot of numerical history of their performance. So we'll talk about that in a bit. But when you read the process document for a quant fund, what you should be looking for, in my opinion, is one, simplicity, right? In my experience, the more complicated a model, the more, the number of moving parts and bells and whistles that go into a strategy, the higher the risk of something going wrong. Again, no offense to, I myself have worked in a field where we even use 3,000 parameters to trade. Right? And even that works. But simplicity in investing as well, even in active investing, to be honest. Right? Simplicity is a risk mitigator, in my opinion. Right? So anything that looks like over complexity, that we look at these 50 parameters and we do this and that, etc., I would sort of be a little cautious of that. Second would be the level of transparency. How much is the fund manager willing to reveal to you in that document about the process, right? So some can be extremely opaque. Some will just say, oh, we take these three, very top level view and we put them together. They will not explain how it is put together, what screens they use, what filters they use, etc. It'll be just, it'll be a very trust me kind of document. I'm very smart. I know what I'm doing. Trust me, it'll be a good fund. Versus somebody who might actually come in and really take you step by step. Look, this is what we do. This is then. This is then. This is what we do. I would trust that more, even though I may not necessarily understand the impact of all of those things. But this willingness to, not be a black box and be more transparent about how the fund is put together makes it sort of a lower risk thing, for the simple reason. Again, I'll tell you why. This is, if you're familiar with open source software, right? So when you use open source software, there's so many people looking at the code that if there is something wrong, if there is some potential for problems, people can point it out. Similarly, in a fund, if there is a process very transparently, then there's so many smart people will be able to say, no, this is a bad process. But if it's a black box, you really cannot trust. So transparency, simplicity of approach, those are the two things that you would, and whether there is, how much discretion does the fund manager have. Sometimes it will not be very evident from the document. So you sometimes have to read between the lines on whether it seems that the fund manager is going to do a lot of tweaking, or is going to sort of keep his hands off this thing. So that's the third thing. Whether there is too much fund manager discretion. If you're investing in a quant fund, you don't want too much fund manager discretion. And finally, back tests. So fund, a back test, what is the level of detail that they have disclosed about their back test? So most simple thing they can be say, this strategy generated 14% annualized returns in the last 15 years, right? There's the least amount of disclosure. And then there can be, they might give you monthly returns. They might show you, a lot more detail. They might give you sample portfolios over time, etc. So the greater disclosure in the back tests, you would sort of end up trusting that fund.
Right. So it's still a tricky one, and it will require some effort on part of the investor or whoever is advising the investor to sort of do that homework so that decision making is sort of sorted, and then you will choose one from the shortlist. In my previous question, I pre-made an assumption and said that let's say I want to allocate 10% to my portfolio. Now this itself is a difficult sort of problem to solve. How much should I invest? What percentage of my portfolio should be invested in quant funds? Can we even have such kind of a allocation where I say that this much percentage of my portfolio should be in quant funds?
I don't think we've, as an industry, still come up to a formulaic answer to that question. So, for example, we sort of have a formula for equity versus debt, right? We'll say the older you are, the more debt you want in your portfolio, things like that. But we don't really have a formulaic answer to quant because it's a sort of nascent segment right now. I think one of the deciding parameters is how comfortable you are with understanding what you're buying, right? So if you are more quantitatively inclined and what you're reading makes more sense, then maybe you can allocate a little more, right? So the first most important rule, I think, for all financial products is, do you understand what you're buying? If you don't understand it, you still want to buy, at least make sure you buy less of it, right? So that, right? So that is one parameter. So if your advisor, for example, happens to be somebody who understands and you feel confident, and this is something very touchy-feely, to be honest, but you can tell when somebody is just, bluffing and when somebody really understands what they're talking about. So if your advisor, for example, seems to know what he's talking about, maybe you'll be more comfortable in having a higher allocation. As a rule of thumb, to be honest, I would, let's say if you're a first time investor, I would say maybe stick to 5-ish% so that, and give it a couple of years, see how it behaves. right? And so the one important thing is you don't want to invest so much that when it wobbles a little, you are forced, you're so scared you sell everything, because then there's no learning.
Yeah.
And right now as an industry, we are at a place where we need to learn how these things behave. So you want a smaller exposure, maybe 5% of your portfolio. And so that you can hold on to it, even if something's going on, and then begin to understand how this works, etc. And then as you feel more and more comfort, you can keep. The way to think about it is, let's say you've already decided between your active and passive allocation, right? Let's say you've already decided that I'm going to do 60% in just index funds and 40% I'm going to do in active. So the way I actually think of it is, you want to think of most quant funds as an allocation within your passive. It's like, yeah, it's almost like a passive plus sort of thing. You instead of just buying Nifty, you want to buy something that makes sure it picks, slightly the better of the lot, etc. Yeah. So you want to sort of shift a little bit from your passive side into quant is the way. Again, sorry, I don't have an answer to the percentage, but that's where you should sort of come to it from, right? You say that, okay, this is basically like a passive investment, but slightly smarter way of doing passive. So if I'm 50% of my stuff is in passive, maybe I'll take like a 10% of that branch and move that into quant and see what happens.
Right. No, so that's actually a very good point that you're making. On a active versus passive investment approach, quant funds are more towards the passive side, right? Technically, they can't be classified as passive funds, but they are more aligned towards a passive approach to investing, where you don't tinker with a model, and you invest within a particular sort of set of rules, and try to sort of, except for adjustments to your models frequently, or as and when required, you don't make changes. So in that sense, they're more towards a passive approach to investing, and that's a great way to think about it. That if I, as an investor, understand what is passive, and then I can allocate some portion of my portfolio, whether it is whether it is 5% of the overall portfolio or 10% of the overall portfolio, that is depending on what the investor's appetite, investment horizon, etc might be. Of course, the industry itself is at a nascent stage, but to be very honest, even our appreciation of the passive space itself is at a very nascent stage. Index funds, if you see the average vintage of index funds, you'd find that most index funds have come about in the last 2-3 years, or a larger majority of the index funds in terms of count. I'm not saying in terms of the assets that are with index funds or with passive funds, but yeah, but we are evolving as a investing nation very quickly. So hopefully this space will see a better understanding, and some of these discussions that we have with folks like yourselves help increase the understanding of the product and of the investing approach.
We need a lot more of these conversations.
No, absolutely, and it really helps to sort of demystify, because you think of this as something exotic when it is not. And when you think of something as an exotic investment, you will have less confidence. It's easy, or rather, let me put it this way, that if you think of something as exotic, you will take a 1% bet on it very easily. But for you to take a 10% bet, it cannot be an exotic strategy. So you have to really understand and appreciate it, which will come, and I'm sure this is something that will happen over a period of time, as there are, not only as the space itself in terms of number of options increases, as some of these funds acquire vintage and are able to demonstrate, not just on the basis of backtest, but also on the basis of the actual fund performance over that vintage. That understanding will increase, appreciation will increase, and also likely that investor flows will also increase to these funds. So that brings us to the end of our discussion today. should any of our investors have any questions, we will collect them. Maybe some of them will come through comments, or some of them will write to us directly. We may reach out, Parijat, to you for another discussion at another time, or if some of these questions are simple, then you can give us your responses.
Would love to answer any questions.
All right, Parijat, thank you so much for joining us, and it was great to have you today.
Thanks, Neelabh.
Mutual fund investments are subject to market risk. Read all scheme related documents carefully.